So you wouldn't be here in this room if you didn't already know that smart beta was threatening to take the investment industry by storm. And certainly there's no denying that we see a great amount of demand for our clients. And it's no surprise that they're interested in the potential for better performance at a lower fee. So the demand aspect of smart beta is quite clear. But what about the supply? What is it that makes smart beta possible, and why today? Why are we suddenly seeing smart beta as such an important driver of the investment industry? And I'll build on Paul's remarks. I think it really has to do with the rise of data and technology. So most of you have at least one, if not two, electronic devices sitting in front of you today. And we use those electronic devices to do everything from buying a metro ticket to sending an email to transferring money. So we leave our digital fingerprints all over the economy. So think about the way in which your lives have changed in the last 10 years, even in the last 5 years. If you were coming to my office in San Francisco 20 years ago, you would have rung up the receptionist and asked her for directions, and you would have jotted that down on a notepad and tried to find your way. 10 years ago, you would have put my address into Yahoo Maps, and you could have printed that out and put it in your briefcase. 5 years ago, your car probably had GPS to give you turn-by-turn directions. And today, in San Francisco, there's an app called Waze, which crowdsources traffic in real time to give you the optimized, fastest route to your destination. So our lives are changing, and so too is the investment industry. 20 years ago, basic insights about valuation or dividends took a sea of analysts that were pouring through financial statements, and having a computer qualified you as a quant. Now today, that information about dividends is freely available from the computer that you carry in your pocket. So we can build portfolios in ways that we simply could not before. The supercomputer of yesterday is the phone that you carry in your pocket today. So the rise of data and technology have really transformed the investment industry, and the sheer breadth of data and the computing power that's available have really shifted the balance of power. So the information that was once only available to Wall Street insiders was a meaningful source of informational advantage that could be used as alpha, that could be exploited as alpha. But that information, because of regulatory reform, because of technology, has been democratized. We all have access to that information, and we can use that to build portfolios. We can use that to redefine the notion of passive investing. We can build an index portfolio that tracks a cap-weighted benchmark, but we can also build an index portfolio that captures proven drivers of investment return that have historically outperformed a cap-weighted benchmark, otherwise known as smart beta. So I want to spend the next 20 minutes or so talking about the many human choices that are required in both strategy design and implementation to help us develop good smart beta strategies to ensure that it actually lives up to its promise of improved performance for investors. So let me start by talking a little bit about the state of play in the industry today. So this chart shows you the historical growth of the smart beta industry over the last 4 years or so. And the ETF space has certainly been one of the fastest growing parts of the investment industry today. And smart beta is capturing about 1 out of every $5 that's going into the ETF universe. And dividend-weighted strategies were probably the first that were widely adopted before we called this smart beta. But more recently, we've certainly seen the broader adoption of things like minimum volatility strategies, equal-weighted strategies, factor strategies, both single-factor and multi-factor strategies. This teeny tiny purple sliver at the top that you can barely see, that's fixed income. Very, very early days for smart beta fixed income strategies, but an area where we expect we'll see a lot of growth. There's much room for potential improvement in fixed income that we can use in smart beta. So the growth is strong, and the growth is global. Growth is actually fastest here in Europe, with annualized growth over the last 3 years around 40% here in Europe. Canada and Asia right on our heels at around 30% each, and the US looking like a laggard at 27% growth, but remember that's off a much larger base, with the US a bit farther along in the adoption of smart beta strategies. And the chart on the right shows the complexion of smart beta adoption in each of those regions, and you see similar trends that as the market becomes more developed, things like dividend-weighted strategies being replaced by minimum volatility, multi-factor strategies, and so on. So very similar trends globally. So the landscape is growing quickly and becoming more crowded. I counted over 700 smart beta exchange-traded funds last time I looked, so there are a lot of choices. So does that mean that we can just let the machines pick stocks and head off to the Oktoberfest tents? Unfortunately not, or maybe fortunately if you're an investment professional. There are many human choices in strategy design and implementation that have a big impact on the total performance experience of our clients. So what should we be looking for when we're trying to sort through the many smart beta strategies to find the good smart beta strategies? And I would say there are 3 things that matter most. Factor exposures matter, portfolio construction matters, and implementation matters. So let me take these things one by one. First and foremost, factor exposures matter. And again, I'm part of the factor-based investment team at BlackRock, so it's probably no surprise that for me, this is by far the most important aspect for us to be concerned with. So what do I mean by this? Factors are nothing more than broad, persistent drivers of returns. They are the fundamental building blocks for all portfolios, and they are the mechanism by which smart beta has the potential to outperform a traditional cap-weighted benchmark. So you could think of as factors are to assets, just as nutrients are to food. As a healthy diner, you need to look through the foods that you eat to the nutrients that they contain. A big piece of steak and a glass of milk, they both have fat and protein. And you're going to find economic growth in your public equity portfolio, in your private equity portfolio, in your high-yield bond portfolio, and probably in most of your hedge funds. So we want to look through asset class labels to understand the underlying factor exposures that are delivered. And it's only by understanding those basic drivers of risk and return that we can successfully build strategies, that we can construct portfolio rules that are more robust, better diversified, and have a higher probability of meeting investment goals. So what are the factors that matter? So this chart describes how I think about the world of factors. So first and foremost, there are macroeconomic factors, and these explain asset class returns. So these are things like economic growth, interest rates, inflation, credit. These are non-diversifiable, systematic risks that are always positive over the long term. So if you buy nominal bonds, you're exposed to interest rate risk and you're exposed to inflation risk. And there's no amount of diversification amongst nominal bonds that can take those things away. So you are paid a premium for bearing those risks. Always positive over the long term, could be positive or negative in any particular month and even any particular year. Now within asset classes, we also believe that there are intuitive investment styles, things like value, momentum, and quality that historically have had a positive return because of a risk premium, a structural impediment, or a behavioral anomaly. So value, for example, nothing more than the notion of looking for inexpensive names, seeking value. That's mostly a risk premium. Value stocks tend to perform poorly when the economy sells off, so you're paid a premium for bearing that risk and weathering that uncomfortable period. Momentum, for example, is more of a behavioral anomaly. Investors, both institutional and individual, tend to look at recent performance and extrapolate that into the future. So even though we know these things exist, historically they've had a positive return and not been arbitraged away because of that risk premium structural impediment or behavioral anomaly. Now, factor investing makes these things accessible and affordable. But what's delivered above and beyond that is alpha, and alpha can only be delivered by a skilled active manager. So we want to understand the complexion of every portfolio to this set of exposures. And we see many of our clients applying this way of thinking throughout their enterprise as a lens for strategic asset allocation, directly targeting these in strategy design as a source of potential return, and even as a framework for the evaluation of individual managers. So let's apply that lens to a couple of smart beta ETFs. So I've plotted here the style exposures for 3 non-cap weighted ETFs. And they sound like they're quite different strategies. One's a dividend fund, one's a value factor fund, and one's an equal weighted portfolio of Canadian banks. And you could think of the values of these exposures as being normalized over a global universe of large, mid, and small cap securities. So on average, all 3 of these portfolios tend to be weighted in larger cap names. They tend to be weighted in lower volatility securities, and they tend to be biased away from momentum. So these 3 very different funds have very similar style characteristics. So in a year like 2015, in the front half of the year, momentum was one of the most positive factors. And this negative tilt away from momentum would have been a headwind for all 3 of these portfolios. Now in August, when momentum sold off, that would have been a tailwind for all 3 of these portfolios. So we want to understand what we own and how the pieces add up. If we're combining strategies together in a multi-manager portfolio, be they active or passive, we want to understand if individual strategies are diversifying or if they're simply compounding unintended risks. So factor exposures matter. And portfolio construction matters. Portfolio construction matters because it is those choices that give rise to the factor exposures that are ultimately driving performance. But very subtle differences in portfolio construction can result in big differences in performance. So here's an example. If you have someone that's looking for exposure to a value type of strategy, they could look at a traditional cap-weighted value index, they could look at a fundamentally weighted index, or they could look at a value factor index. And I've plotted a version of those 3 things relative to the standard MSCI World in purple. So the yellow line, that's the standard MSCI value index. So we're looking at what the difference is in security selection or screening and how differences in the weighting of those securities give rise to differences in performance. The standard value cap-weighted index, it's screened. It only includes a subset of that universe that are the cheapest securities, but they're cap-weighted. So you get a little bit of a loading towards value, and that provides a little bit of a performance improvement relative to the standard MSCI World. If we look at a fundamentally weighted index, like MSCI Value Weighted, that includes every security in the universe, but weighted in proportion to the value score. So you get a slightly larger loading to value and a bit more of a performance pickup. That's the green line. In a value factor index, it's both screened and reweighted. So we include only the subset of securities that have the best loading to value, weighted in proportion to that value metric. So you get the highest possible value loading and the highest possible performance pickup as a result. Now, this particular value factor index is also sector neutral, and that also tends to improve the performance of a value strategy over time. So very subtle differences, what sound like small changes in portfolio construction, can give rise to a big difference in the performance that you experience. So portfolio construction matters, factor exposures matter, and lastly, implementation matters. So we know that turnover is higher and liquidity is less advantageous for smart beta strategies relative to a cap-weighted index. So something like MSCI ACWI, a global cap-weighted index, has a turnover around 3 to 5% by basis of comparison. And most smart beta strategies range anywhere from 20% for min-vol to 40 to 50% for a multi-factor index to upwards of 60% for some single-factor indices. So that kind of turnover can quickly erode the potential benefits of a smart beta strategy. So it's critical that we choose an implementation agent that really understands the methodology and can put that methodology in the context of global capital markets. So we don't want to just blindly trade to benchmark on effective date, but to logically trade off very thoughtfully the potential return with the potential risk and the potential cost. So what I've plotted here are the implementation results for the four largest index managers in the world for their flagship S&P 500 funds. Now, the S&P 500 is arguably the most replicable index in the world, right? Large cap US equities, it doesn't get more tradable than that. But there can be very, very large differences in the excess performance. So this is the performance of the fund relative to the S&P 500 over 1, 3, and 5 years. So as much of a 12 basis point difference across providers in something as transparent as the S&P 500. So as we get into strategies that are more complex, that are less liquid, with higher turnover, you can imagine that the potential slippage is even larger. So implementation is critical for successful smart beta strategies. So how can we actually put these ideas to work? So let me give you 3 recent examples of how we see clients putting smart beta into their portfolio to address some of the challenges in the marketplace today. So BlackRock, like most other managers, is predicting a rather tepid environment for traditional asset classes looking forward. So we'll be lucky if we get sort of low to mid single digits in stocks and bonds in the next couple of years. But we know that our clients still have to meet actuarial assumptions. They still have to meet their retirement goals. So the potential for incremental returns is all the more important in a low return environment. So we see a lot of clients looking for return-seeking smart beta strategies that can add incremental returns at a reasonable fee. So something like a multi-factor smart beta strategy that explicitly seeks additional return can be blended with traditional cap-weighted index funds. Now, how much you blend in, that depends on how much return you need to achieve and how much active risk you're willing to take on. And that's what's shown in the leftmost chart there as we combine a traditional index with a smart beta index. Now, this year we've also seen the return of volatility with a vengeance. August reminded us how fickle markets can be. And certainly low volatility strategies have been amongst the most popular smart beta strategies in 2015. So a lot of clients looking for downside risk protection in their portfolios. They want to be protected from equity market downturns, but they still need returns. So a hallmark of minimum volatility strategies is their asymmetrical effect, and that's what's shown in the middle panel here. So something like AcquiMinVol, for example, has historically captured 70% of the market's upside, but only 40% of its downside. You get proportionally more upside participation than you do downside. So you can stay invested in equity markets, you can stick to your long-term investment objectives while getting some downside risk protection. The third panel looks at an example in fixed income. Certainly today's fixed income environment is challenging for most investors. Yields are exceptionally low, and traditional bond indices are concentrated in interest rate risk. So you have a lot of rate risk, and you're not paid particularly well for taking on that kind of risk. And most of us are expecting interest rates to start rising in the foreseeable future, with both the US and the UK promising increased interest rates. So what's a bond investor to do if traditional fixed income portfolios are giving you a lot of duration and not paying you for that risk? Well, you could shorten duration and further lower your yield at a time when we're starving for it. Or you could allow an active manager to pursue a more unconstrained strategy, and that allows them to make more choices about the sources of return that they capture in an active fixed income portfolio. Now, make no mistake, we're big believers in unconstrained fixed income at BlackRock, but that also involves higher management fees, higher transactions costs, and certainly a higher tracking error than some investors are willing to capture. So we could also write index rules to try to create a more diversified fixed income index, to look at not capturing not just interest rate risk, but other sources of return, namely credit. So if we think back to that chart I had a few minutes ago, what are the 2 most important drivers of bond returns? Interest rates and credit. So let's diversify those 2 things in a fixed income portfolio and try to put yield into an index fund with less duration. Now, I mentioned that we have some clients that are starting to use this way of thinking as a framework for manager analysis as well. So we could think of applying this lens to any portfolio, be it active or passive. Now, traditionally, we've compared active managers to their stated benchmark, call it the S&P 500 or the FTSE Europe. Anything that was delivered above and beyond that benchmark we called alpha. But increasingly, we recognize that a portion of those active returns are actually due to the exposure to smart beta factors, things like value, quality, momentum, and size. So what we want to understand is what is the proportion of their returns that is as a result of those static exposures, and what is above and beyond that, that's true alpha. That's a result of security selection, of market timing, or even the timing of factor exposures themselves, which is a very subjective and active decision. So what the charts on the right show is some analysis we did on 138 global active managers that report to the Investment Alliance database. And so what we've plotted here is the proportion of their active return that's due to smart beta exposures. So we're looking at individual portfolios on the upper right. On average, around a third of their active risk comes from static exposures to smart beta. And for about 35% of managers, more than half of their active risk comes from static exposure to smart beta. And there's a range. Some of them have a lot of exposure delivered, and some of them are very idiosyncratic. We want to know which is which. Now, most clients probably don't have one active manager. They probably have 4 or 5 or 10, 20. And of course, as you combine multiple portfolios, you're diversifying away stock-specific risk, but you're compounding those factor risks, right? So in a multi-manager portfolio, we see even more of the active risk is actually due to static exposures to smart beta factors. So for a randomly constructed 10-manager portfolio, on average, about 55% of the risk is due to smart beta factors. So we want to understand how the pieces add up and try to isolate those managers that are truly delivering alpha and capture smart beta in a more affordable and accessible form. So what does the future look like? My view is that we will continue to see the broad recognition of factors as a very important driver of investments throughout the industry, as a means of asset allocation, as a means of strategy design, as a means of potential return, and as a lens for individual manager evaluation. And the good forms of smart beta empower access to those proven investment insights. It makes them accessible and affordable to the largest institutional investor and to the smallest mom and pop. Now, it's up to all of us to make the smart human choices that are required for smart beta to fulfill its name. Thank you.